Dear viewers, have you ever imagined a company with barely $100 million in revenue signing a multi-billion-dollar contract with the world's largest software company just a few months after relisting on the Nasdaq? It may sound impossible under normal circumstances, but the story you're about to hear is not just possible, it actually happened. And at the center of it is a company called Nebius Group. This company, officially headquartered in the Netherlands, presents itself as a global tech group focused on cloud infrastructure for artificial intelligence, specifically high-performance GPU-based data center services. In addition, the company operates a data labeling platform called Toloka, a coding education platform named Triple10, and a self-driving technology unit known as Avride. Tracing the roots of Nebius Group leads us straight to Russia. The company originally served as the holding company for Yandex, once considered the Google of Russia. Yandex was known for its search engine, maps, self-driving division, and much more. However, in 2022, following Russia's invasion of Ukraine, Yandex was suspended from trading on the Nasdaq. Roughly 20 months later, in July 2024, Yandex's Dutch holding company sold off its Russian assets for approximately $5.4 billion. What remained of its international operations was rebranded as Nebius Group, which resumed trading on the Nasdaq in October 2024. Under normal market conditions, a company emerging from such circumstances would require years to clean up accounting, separate assets, reestablish corporate governance, and pass regulatory scrutiny before returning to public markets. Nebius Group, however, completed this entire process in just a few months. If that weren't unusual enough, the company soon announced it had signed a major deal with Microsoft, one valued at $1.7 billion, and up to $2 billion including options. But here's where the real mystery begins. Deals of this scale typically follow years of evaluation, due diligence, technology trials, and infrastructure audits. The supplier's revenue history, operational readiness, and infrastructure quality would all be thoroughly validated. In Nebius Group's case, however, the contract was announced just weeks after relisting. This raised immediate questions among investors. According to its Q1 2025 earnings release, Nebius Group generated approximately $55 million in revenue and remained unprofitable. In Q2, the company's revenue climbed to around $100 million, and it reported adjusted EBITDA profitability in its core segment. Yet it remained unclear whether any portion of this revenue included Microsoft contract activity. What's more concerning is that the Microsoft contract remains vague. The full contract has not been disclosed. Public filings from Nebius Group provide no details about revenue recognition, GPU shipment schedules, chipset types, margin structures, or any prepayment terms. Microsoft, for its part, has not officially commented on which quarter it will recognize this contract in its financials. Meanwhile, Nebius Group launched aggressive fundraising efforts. In late 2024, the company raised approximately $700 million in private financing. In September 2025, it announced a plan to raise an additional $3 billion through a combination of $2 billion in convertible bonds and $1 billion in public equity. This too deviates from market norms. Typically, a company that lands a multi-year strategic contract of this size would receive an upfront payment or secure minimum revenue guarantees, allowing it to fund infrastructure expansion organically. Instead, Nebius Group is tapping external capital markets for large sums and diluting its shareholder base in the process. That alone has deepened investor doubts about whether the Microsoft contract is truly being monetized or simply being used to justify aggressive fundraising. Adding to the mystery, the infrastructure supposedly supporting the contract may not yet exist. The company has announced plans to build a massive data center in Vineland, New Jersey, and to deploy GPU clusters in Kansas City. But timelines, power purchase agreements, and chip acquisition status remain undisclosed. In other words, the physical backbone needed to deliver on the contract may still be under construction. This leads to a very reasonable question. Is this a real contract that will generate revenue? Or is it a non-binding option contingent on future milestones? And are the company's current plans and financial maneuvers a reflection of solid deal execution or a carefully orchestrated attempt to boost investor sentiment? This case matters not just because of one company's business practices. Nebius Group now commands a market capitalization of roughly $260 billion, more than 100 times its annual revenue. If that valuation is based on hype rather than substance, it's investors who will ultimately pay the price. If you know of any companies, listed, unlisted, or planning to go public, that raise similar questions or merit deeper scrutiny, we encourage you to share them in the comments. The Valuester channel welcomes your tips and suggestions, and we'll investigate them thoroughly from a long-term investor's perspective. This was Valuester.